Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, how you can collect a premium upfront and generate consistent returns year on year. So of course the method that we're going to be implementing is going to use options contracts. So we need to know where we are in the options cycle. So the first thing we want to do is just pull up any underlying and head over to the options chain tab. And now we can see we've got a list of expirations. We've got our weeklies and our monthlies. We like to stick with the monthlies for the purpose of what we're going to be doing in this video. And we like to be between 30 and 60 days out. So October 18th is the next one, 23 days away. It is a little bit too close for us. So we are going to be going with the November 15th, 51 days out in time. So now we know our contracts are going to be 51 days out in time. What we can do with that information is come over to our watch list and filter out everything that has earnings over the next 51 days. So what we'll be left with is a list of underlyings that do not have earnings over the next 51 days. And we can also filter out the low liquidity level stuff. So we're only left with the top tier liquidity level underlyings. And now what we want to do is list everything from high IVR to low IVR. The reason for this is we want to sell volatility. We want to sell it when it's high and play the contraction. And volatility also contracts about 80% of the time in the market. So we definitely want to be on the side of volatility. And now we can see we've got our watch list all ready to go. At this point, we simply just go down the list and see what looks good. So before we do that, you want to keep in mind what's already in your portfolio, and you want to make sure that you're not going too heavy on any one thing. If you've already got a lot of one type of stock or one type of underlying or one industry in your portfolio, maybe try and go with something else, something opposite, something non-correlated. So just keep that in mind as you're going down the list. SLV, GLD. SLV's got a very nice IV rank today, and so has GLD. To be fair, I think we could just go down a little bit though. We want to stick to something with about an IV rank of 50 or more. Of course, it's not the end of the world if it is a bit lower. Anything over 30 is okay. I mean, I think we could have a look at XLU. It's got an IV rank of 33, which isn't the best. However, it is one of the spiders. It is an ETF, and an IV rank of 33.3 on an ETF isn't too bad. So we're going to take a look at XLU. We're going to go straight to the November 15th. We've already done the work. And now we are presented with the options chain. This horizontal orange line here shows you where price currently is in relation to all the strikes, and the vertical orange bar shows you the expected move of XLU over the next 51 days. Now, we are going to be writing options contracts. Specifically, we're going to be writing one call and writing one put. At what strikes do we want to be writing these contracts? Well, we want to be writing these contracts outside of where the expected move is, of course. We want our contracts to expire worthless at expiration. So what I like to do is go anywhere between 16 and 20 deltas on either side. So if we start with the call side, we can go with a 17 delta on the call side, and then there is a 16 delta on the put side. So we've got a 75. We've got a put contract at the 75 strike and a call contract at the 85 strike. As we can see, this is outside of our expected move, and we have a very high probability of profit. 73% chance of being uh, being at least 1 penny in the profit at expiration, and we've got an 85% chance of hitting 50% of max profit at some point over the next 51 days. We'd get $2.50 of daily theta decay. This position would require just a little over 1.1k in buying power, but we would collect $92 upfront in premium, and this is actually a pretty decent return for a strangle. Like we said, IV isn't the highest, However, it is a pretty textbook vanilla position that we've found. An XLU is completely fine for almost all portfolios. It doesn't require that much buying power. As you can see, it only requires just a little over 1.1k. But if this was too much buying power for you, by all means, you could just buy a contract a little bit further out. So you've got the 85 strike. You could just come a couple strikes lower, say $2 wide, and buy the 87. Do the same on the put side. Go $2. Keep the width the same, so $2 down, 73. Buy the 73 strike, and what that's done is that's created a $2 wide spread on either side. If you noticed, that's reduced the amount of buying power. That's reduced the amount of premium that we collect. However, it has significantly reduced the buying power. So, all in all, this is now a much higher return on capital trade than the strangle that we were looking at. However, we do get less daily theta decay and we do get a lower probability of profit. And that's the trade-off really with this. If you can go without the longs, if I were you, I would just go with this. But if you do need to cover your shorts, by all means, you can cover your position. In addition to following those steps, you need to make sure that you are sizing your positions correctly. Doesn't matter what you do, if you size your positions wrong, eventually you will blow up your account. So what we have created is a position sizing template. It's free for everyone to get hold of. The way it works is you enter in the size of your portfolio. So let's say if it's $10,000, you then below that enter in what the current VIX level is. Let's say if it's at 12.4. Everything below will then be automatically calculated for you. All you need to do is use this information to form the backbone of your portfolio. It will tell you how much buying power to allocate to any undefined risk position, any single defined risk position, and how much of your portfolio you should allocate to short premium in general. And as long as you follow everything here, you'll be fine. If you want to get a copy of this, link is in the description. It'll take you to this page. Just click on the free position sizing template. And if you do want to get involved on the positions that we're actively trading and copy our positions, make money with us, by all means, click the link in the description, head over to EDS Premium, get yourself signed up. It'll give you access to all of our portfolios, large and small, so there'll always be a position for you to copy. There's a full course inside, so no prior knowledge is required. We'll teach you everything you need to know. It allows you to learn and earn at the same time. It is a private community, so you can speak with myself directly and other like-minded individuals. There's also a 100% money-back guarantee, so if you studied our full course, followed our trades for 6 months and haven't seen results, then we'll work with you for free until you do, or you can request a full refund. So it's completely risk-free on your part. It's £1 a month right now. The price will be increasing. However, once you're in, you don't need to worry about price increases as long as you don't quit and then rejoin. So with that being said, I'll see you guys on the inside.